Who has the harder job, VC or CVC? And this is an interesting topic because, as we'll see in this discussion, these two roles are very different. Often CVCs try to say that they act as much like VCs. They're just as astute financial investors. They're quick on deals. They do everything like VCs do. But there is a lot of additional work that a CVC does. In order to help talk us through the topic, I have two eminently qualified people. So let me introduce them quickly. And then Lisa and Harry can fill in a little more about their background as we come to the discussion. But so Lisa Sunan has done kind of every single role that there is to do with startups and venture. But what makes her particularly qualified to talk about the kind of CVC versus VCs? So, she started out, I think you came from the VC side, then went into GE Ventures, leading the GE Ventures Healthcare Fund. Also worked at, is it Cardiation, which was the American Heart Association?
I started that, yeah.
Mm-hmm. You started that. And then came out of that CVC world, went back into financial VC, a variety of roles. And the latest news, hot off the press, which I only learned today, was now going to join a startup. So going right back into the, the full loop-de-loop, I guess, of roles. So having worn all these hats, I think Lisa's very well qualified to talk about kind of how these roles differ. And then Harry Diarte, who lots of people will know from having founded SE Ventures. That was back in 2017, was it, Harry? And ran that very successfully. And then you had a slightly different path into all of this because you came very much from the company side. So having done a lot of operational company roles at places like Alstom, Cemex, etc. And then now you've kind of made the leap into financial VC fairly recently. So this will be fresh in your mind. I think you can probably see a lot of the contrast quite sharply now because this is still something that, you've started doing the last 6 months. So really interested to hear your perspective. And so welcome both. I am just going to introduce myself as well. So I'm Maya Palmer. I am a relatively new editor at Global Corporate Venturing. And as many of you will hopefully know, Global Corporate Venturing, we're a sort of media and market intelligence company. We host events. We have the GCVI membership society. We have the institute where there's a sort of opportunity for professional development of your corporate venturing skills. So we do quite a lot of different pillars of what the CVC investor will need. And these webinars kind of slot into that because they give us an opportunity to talk about some of these dilemmas to a wider audience. And then in some of our institute courses, for example, we would go into a much deeper dive on kind of really how you navigate CVC roles. So I would love to start by just asking the audience and putting a little poll up, which is, which do you think is harder? And actually, I'm going to start this by asking of the audience that we have today, who works in VC and who works in CVC? And okay, that's going very fast. So we have a majority CVC audience, a couple of VCs in there, and a few people who are in neither. So very much a CVC audience, which doesn't surprise me. This is our kind of audience, typical audience. We do write about CVCs mainly. So I'm not surprised to see that. So let's ask the second poll question. Who thinks, who has the harder role, CVC or VC? Okay. And again, this is not surprising because, okay, some people are voting for VC. Okay. So about 72% are saying CVC. This is very similar. So we asked this question on LinkedIn, and our audience there, 79% of them said that it was CVC had the harder role. And again, I feel like it's perhaps those results are a little biased because we have such a heavily CVC audience. They're bound to think that everybody always thinks that they have the hardest job in the world, and perhaps the CVCs are more aware of the complexities. Just to kind of flesh this out a little bit and give us a little bit of food for thought before we dive into the discussion. So some of the reasons why CVC is seen as the more complicated role are kind of encapsulated in these charts, and these were ones that were shared with me by my colleague Liz Arrington, who runs the GCV Institute. And it's really just, you don't have to kind of dive into all the detail of this, but it's showing you here the really complicated ecosystem that the CVC investor has to navigate. So there's all the internal stakeholder management, there's the liaison with the business units at the parent corporation, etc., in addition to doing all the other external ecosystem work that a VC would typically have to do with co-investment partners, startups, and so on. And again, this is, just a very similar thing in terms of, you're navigating in what's already quite a complicated corporate setup where you're looking at a variety of kind of competing functions. So you have your M&A strategy, your R&D, joint ventures and licensing, and then the corporate investment sits somewhere in between this and has to sort of, depending on how it's set up, speak to all of these, maybe speak to none of these, but you're certainly competing for attention and resources with all of these things. So that doesn't help. Just to kind of put the opposite case, this is the sort of chart. I think everybody is pretty familiar with this. I think that I've seen various versions of this knocking around since about 2016. But it's a kind of reminder that, VCs in a way only have one job, right, which is picking startups that will make a financial return. And so it's a pretty one simple lens to look at things. Now, I'm not saying it's easy to find that one that's going to be the great return, but you're looking for one thing. And even with that, it's still pretty clear that not everybody returns, their investment that returns the fund, etc. So, that 5% that become really very successful, still a little bit of a minority. And one of the things that I'd love to talk about as we kind of go into this discussion is maybe, is the sort of CVCs and VCs sort of, or CVCs trying to act like VCs in the sense of being really caring a lot about financial returns is very laudable, but at the same time, they have so many other things. Maybe we're not comparing quite, we're comparing apples and oranges, and this is always going to be slightly disappointing. So anyway, having set the scene, I think it's time to turn to let Lisa and Harry talk rather than just me. So I'd love to start, and I'm going to see if I can stop sharing my screen so that we can see everyone better. But I'd love to start with this kind of question of which do you think is harder, having done both? And maybe I'll start with you, Lisa. So tell us a little bit about, where you are right now, but also, which one was the more challenging role?
I think it depends, right? I think it depends a lot on how the fund at the corporate side is structured and its goals and charter versus, the outside VC fund. I have been fortunate. I've worked both in independent venture funds and in corporate venture funds. And I'm currently an advisor to 3 standalone venture funds and 2 corporate funds. So, in some cases, let me just say at GE Ventures, we were structured mostly like an independent fund. So we had a segregated budget. We had autonomy in our investment committee. We didn't have to go to the operating side for approval. We weren't investing around the core. We were investing kind of in the out blue sky, 5 years out kind of focused range. So we didn't conflict with operations and didn't much come up against the thing where they wanted to build it instead of invest in it or buy it or whatever. And we weren't a substitute for the M&A group. So we were very much more like an independent venture fund than most corporate venture funds. I think the biggest hardship for corporate ventures that makes it a little harder is the whimsical nature of the ends of the fund, because the biggest, correlation to the death of a corporate venture fund is the change of CEO. And CEO change happens relatively regularly in large corporations, not every day, but certainly enough, especially in a volatile economy. And oftentimes when CEOs change, the venture fund is dissolved. And in a standalone venture fund, you have more control over your own destiny as long as you're good at fundraising and have good outcomes, which makes you good at fundraising. So I think, in some ways, the corporate venture fund job is harder from a, self-destiny management standpoint. And there are a lot more politics in the company versus politics among the partners. I'm not sure which of those is harder, frankly, because I've seen both of those play out in not great ways.
And so even at GE Ventures, which, you know, by all accounts, it was hugely successful in what it did. It was set up in a very independent way, and yet it still kind of came a little unstuck by some of those, you know, the management change type of thing.
It was killed by management change. I mean, it was killed by a management change and a change of financial fortunes of the company. Not because of its performance, which was stellar, frankly. And it was interesting fund also because I'm thinking now all of the people that worked for me anyway in the healthcare fund and most of the people from the other funds had come out of independent venture capital organizations, not out of operations. So we were very experienced in the art of venture capital, such as it is. And so it was an unusual corporate venture fund, I think, in some ways. But having said that, and having worked with many corporate venture funds as a strategy consultant as well, the complicated chart you drew there, or that somebody else drew, is real. I mean, it's definitely a lot of people to pay attention to as you think about the job.
Yeah. But no, I can hear the sort of frustration that you can have these stellar results, which would have any, you know, LP, you know, sort of rubbing their hands with glee and saying, you know, go do more, go faster. And yet then, I mean, was there, I think sometimes we talk a lot about how to protect, you know, a corporate fund from management change, but it doesn't feel like you can necessarily do that effectively ever.
I don't think you can. I mean, it's really subject. I mean, you can give it a little more life by giving it actually setting aside a separate fund structurally that has a commitment that's legally binding in a way, but it's pretty hard to enforce that. I mean, what's the corporate venture fund going to do? Sue the parent? I doubt it. So I think it's very hard to protect. And, you know, on the standalone venture side, your best protection from, you know, demise is good results, right? So if you have good results, you're likely to be able to raise another fund. And nevertheless, those funds have a certain shelf life too, in most cases. I mean, they're not that many funds that live for 20 or 30 years. There are some, obviously, but they're not, it's not the most common outcome.
Yeah. Okay. All right. Well, so Harry, maybe to bring you in, and so just tell me, what's your sort of gut reaction answer to that? Which one is harder? And then, you know, tell us a little bit about sort of the SE Ventures story, because again, that was set up in a way that it very much felt quite independent. You came in with some strong ideas about how it should be run, and carved out quite a lot of freedoms for yourself.
Yes, and that worked really, really well. For many years, we had a lot of freedom, independent decision making. Carry, we were very close to what you could say is an independent CVC fund, and that worked really well. Both strategic results for our parent, who had a long list of KPIs we can talk about later, and also financial results. So that worked really well. But as we became more successful, we became increasingly entangled in internal conversations, because at the beginning, nobody cared about us so much. But when we started achieving some good results, we became very visible. And then we were the go-to for anything to do with innovation. Hey, what should we do about crypto? You should know something about this. And going on a wild goose chase to figure out what do we do with crypto and so on and so forth. So we, at the end of my time managing SE Ventures, I was spending at least 50% of my time managing my stakeholders internally, which is really, really hard. And it's a needed thing, but it's not what I enjoy so much doing, right? I enjoy working with startups, meeting startups, helping them build businesses. But SE Ventures is doing phenomenally well. It will continue to do very, very well because structurally set up in the right way. We didn't get to be completely like an independent fund like Sapphire Ventures or something like that, but we are as close as you can get to in a CVC to that.
Yeah.
Now, addressing your question, what is harder, CVC or VC? So I've been in a pure financial VC for only 2.5 months, but I will divide the answer depending on the time horizon you're looking at. I believe that in the long term, medium and long term, results based, VC is harder than CVC. And I'll explain why. And in the short term, CVC is harder than VC. Let me explain what I mean. In a pure financial VC, you need to deliver those financial results that are better than your peers to be able to continue fundraising. In a CVC, there are other values that you can bring to your LP, to the corporate, that are not necessarily financial. They're doing it for other reasons. They're doing it for innovation. They're doing it for market intelligence. They're doing it to digest and acquire or partner with new technologies. So for example, in a CVC, if you invest in a company that has some really good technology that your parent company can use, and they absorb that technology or whatever, that is a win. Whether the startup was a resounding financial success or not, that is a win for the corporate, and it's a great success for the CVC. In pure VC, that is not a win. Your investment has to do 5x, 3x, otherwise it's not a win. So there are other ways in which a CVC can add value and be considered a success, and in a pure financial VC is only your returns. So in the long term, that's harder, and also the fundraising part. I didn't have any experience fundraising, and it's hard. It's really hard to do that. I'm doing that now, and you have to really prepare. You have to be better than others. You have to have an angle. So it's like you're on the other side. You're raising money from sophisticated people, and that is not easy. So on the long term, because of the results orientation and the fundraising, VC is harder. In the short term, CVC is harder because you have to manage so many stakeholders. Your heads of R&D, your business unit leaders, your supervisory board, the strategy people. There's a lot of people that you have to manage, expectations, knowledge, bring on board, try to deliver the results you gave to your startup. There's a lot of stakeholder management, and that makes it really complicated. And it's political and so on and so forth. And so that makes it really hard in the short term, just doing your day-to-day job. And you have to do that. You're there to create some value for your LP. So you have to do that work that sometimes you will feel is not adding value to me or to my fund performance. That's right. But you're adding value to them, and that's what you're there for. And it's hard. I have to say that now that I'm in a pure VC, I feel liberated. I don't have to do any of that. I'm just spending 90% of my time talking to startups, working with startups. The politics of the stakeholder management in a real VC, in a financial VC is very close to zero, and it's really wonderful. So I'm enjoying myself much more. Yeah. So in the short term, CVC is hard.
Do you know what I found really interesting that you said, Harry, was that it actually, the stakeholder management became more as you became successful and you started to be noticed by, the parent corporation. So that in the beginning, maybe you had more freedom to just kind of pursue, and then as they kind of saw you. So that's something to kind of, for people to maybe bear in mind for their fund, that as you almost have to budget more time. As you would expect that things would become more, easier as you get more successful, right? People would leave you alone to don't kill the goose that's laying the golden eggs. It's the opposite.
It's the opposite because now you have a large portfolio and it's starting to do things, and the people inside the company want to know those companies. They want show and tells, they want meetups, they want this and that. And like I think Harry said, that you get to become sort of the people they trot out when there's an innovation discussion about any type, and it can get very challenging. And I think the other thing is you start to believe yourself, that the purpose of your existence and you becomes very real as these companies in your portfolio mature. The best way you can help them a lot of times is to get them business from your company. And so you need to, spend time trying to negotiate those relationships. As we grew bigger and bigger at GE Ventures, we started hiring more and more people that were just focused on portfolio sort of, matchmaking within the company and shepherding the business relationships from a business development standpoint. On the venture side, it's much more about, making connections for people, using your network to help them, but you're not really like living and dying by, your own connections for those companies, the way you are expected to on the CVC side.
Now, I want to say at this point, actually, that we're starting to get some questions in, and I would encourage anybody who wants to ask questions to put them in the Q&A function, because I just think this is a good opportunity to pick the brains of two extremely experienced people. And because we're starting to get some, I think, Laurence de Jong has gone straight in for the question, right? The sort of the remuneration one. And I was going to get to that, but maybe we can jump into that right now, which is, carry. Should you have it? Should you have some sort of synthetic carry? I mean, Harry, it sounded like you had carry at SE Ventures. Lisa, what was the GE Ventures system?
No, we didn't have carry. We had good salaries and bonuses, also good, but not carry. And I think it's pretty unusual for true carry to be given out by CVCs. I mean, it happens. Obviously, Harry had that, and I've seen a few others. McKesson does that sort of. They do like a shadow carry kind of a thing. I think that's more common, and then no carry is the most common. So it becomes harder to attract, the more experienced investors a lot of the time because of that. On the other hand, what I would say is the ability of most financial venture funds to deliver meaningful carry to their partners and people is less than people may realize most of the time. If you think about that returns chart, right? You've got to overcome the capital raised, a certain IRR, usually a hurdle rate before carry is distributed. It oftentimes is 7 to 10 years before you see a dime of it. And if you see anything material, and by then you might have made that much in, salary and bonuses. So it's a bit of a, complex calculation, I think.
So you'd say maybe people make too much of that, the temptation of I could get carry, I could get great carry somewhere else. It's actually maybe not as golden an opportunity.
I think people have some fantasy that you get returns in 3 years or something, and it's pretty rare for that to happen.
But Harry, how did it make a big difference at for you at SE Ventures? Was it a good kind of recruitment tool? Or
absolutely, I really believe that all CVCs should have carry, and I'm offering to all of my colleagues there, if you want me to help you to talk to your management to put that in place. I've done it for 3 companies that successfully put carry on. I think it's a great tool, and let me explain to you why. First of all, what are the profiles you need in a successful CVC? I agree with what Lisa has said about this partnership team. We call it partnership team. Others call it the business development team. Others call it the catalyzer team. When we started in SE Ventures, we had one person who was making the relationship between our portfolio companies and Schneider Electric to look for those win-win collaborations. When I left, we had built a team that was 8 people. That was bigger than the investment team, because that takes a lot of time. But that's how you create value for your LP, but also for your portfolio company. So that's one profile, and they were all company people who had the network and knew who to talk to. On the investment side, we had investment professionals, people who have been doing this for 10 years, have invested in companies, and they have the judgment to pick the winners, to help them, and so on. That's a profile. To attract some of the best people on that profile, you need to give them that incentive that this is Adam Smith, right? This is if you do really, really well, you're going to make a lot of money. And there is a correlation between the best strategic value and the best companies. Corporations are going to get the best strategic value from really successful companies, because those are the ones that have the better technology, that have the better fit with the market, that have the better management to support you. So there's a correlation between the strategic returns that you get and this how successful that company is going to be. So you want to incentivize your people to find those really rare companies that are going to be the winners on each category. So carry is very important for that. And in SE Ventures was very successful because we were able to hire phenomenal investors that had many different options, including with real VCs, because we could offer them a very strong remuneration package, both on the cash, but also the potential of the carry.
No, it's interesting. I mean, I have spoken to some, CVCs where they they said that, you know, Carrie definitely helped them, you know, retain people for longer. So it is interesting. Would love to stay on the Carrie point, but we're getting so many good questions. Thank you, everyone. I'm going to just, like, the next one, I'm just going to leave it to the audience to ask the questions, because these are so good. So let's just try to work through some of them, because I think they're touching on points that we would have wanted to get to anyway. There's one here from Justin Merle, which I think would be to just talk about the, you know, the differences in cultures between corporate VC and financial VC. So expectations, day-to-day work, work-life balance. I'm actually interested in the work-life balance bit of that. Is there any difference? Is it just a kind of intense job, whichever you do, or?
I think it's both intense and sometimes not intense. I mean, culture is always defined by the people, right? And I think, so that's part of it. The demands of internal communications and stakeholder management, as Harry said, are big in the corporate venture side, but the pressure to constantly be worried about the company's financial performance excelling beyond everyone's wildest dreams is less. I mean, so there's just a different sort of pressure on the financial venture side. The culture can be great because you kind of make your own hours more so, but you also, there's a lot, you know, politics between a bunch of people who are partners instead of in a hierarchy can get really tense. And a lot of times these things don't go well. And it really depends on how you've structured your voting and your investment committees and things like that in either case. So I think work-life balance can be great in VC. I mean, nobody calls you, you know, when the server goes down at a company when you're the VC, as opposed to when you're in operations at a company. But in the end, you know, like every job is hard if you do it well, and every job has some performance requirements if you do them well, and every job has teams that work well together or don't. And so I'm not sure there's a lot of difference, frankly, between that in that angle.
Yeah,
of the venture world.
Yeah, it's, you know, you're not slacking definitely in either. What do you think, Harry, though? I mean, you know, with your fresh eyes, because you're now at a financial VC, what's kind of, has that made a big difference to your day to day? I mean, I know you kind of talked about the fact that, you know, you're spending 99% of your time now doing the thing you actually like doing, which is talking to, you know, startups. So that's a difference. But anything else that's come up?
That's a very good question, because I don't have a strong view. Usually I have strong views about everything, but not on this one. It hasn't made a big difference. It depends, I guess, the firm that you join. I have some friends who have joined big firms where it's very genteel and they don't work really long hours and so on. The firm that I joined are workaholics, and sometimes I do something that I didn't do before at SC Ventures often, which is work on the weekends, right? We have sometimes pitches and things on the weekends because that's the only time we could arrange things. So in my current firm, people are working all the time. And I've said, I don't work on the weekends, and I have dinner with my family, and I can work after. I set my boundaries, but sometimes we overstep those boundaries. But I'm happy, I'm fine. In SC Ventures, I didn't work on the weekends most of the time, unless I had to travel and so on. What was really difficult for me personally was the time zone in California, working for a global company where we were investing in China and everywhere. I had too often 5 a.m. meetings, too often, really, really all the time. And here in my new work is only Mondays at 6 a.m., which is 8 a.m. in Houston, where we have the partners meeting, you know, the typical investment committee every Monday morning. That's only one day. The rest of the days I start at a very nice hour. So I think it's more or less the same overall.
Okay. No, good answers. Now, here's one which I'm going to throw at you, Lisa, first, because I think you've advised a lot of CVCs also in their setup. So I think you'd be, but I'd love to hear from you, Harry. But so this is the Edward Newton question, which is, you know, your view on the three main success factors when it comes to CVC, or, you know, the opposite, which is the three main mistakes that CVCs tend to make. So,
yeah, I mean, I think, you know, the things that make CVCs most successful are, one, really getting buy-in at the beginning about what the goals and metrics for success are, like getting real stakeholder agreement about how you're being measured and how and what your objectives are, because most CVCs, not all, but most, are as interested in the strategic value as defined by them than they are in the returns, because the amount of returns you can get couldn't possibly equal even the annual profit for most of these companies. So that's number one, with a bullet. Number two is investment committee, structuring. So you have some autonomy over investment decisions, and, having a way to make investments that doesn't come into constant conflict with operations and others, or get thwarted at the treasury level every time you, try. And so I think investment committee structuring and sort of having clarity, that plus having clarity around the purpose and the metrics is critical. And the third, I think, most important factor is hiring experienced venture people, at least in the senior level roles, the medium to senior level roles. Venture capital is a skill set like any other. You wouldn't hire a president of a company division who had no experience doing something like that, unless you're kind of crazy. And same with VC, you need to hire people that are good and not use it as a reward system just for people inside because they want to do it. I think those are the most important factors in success. And in contrast, the opposite are the most important factors in failure.
Yeah. So you don't do those. You're saying, and you're kind of nodding and smiling here, Harry. Because what would you add to that? Because I sort of remember you talking to me about when you came into SE Ventures, and you had a real sort of laundry list of, I want it to be done like this and not like this. So 5 points.
First thing, what makes a CVC successful, or what can you measure? One thing is, and we had those KPIs, one measure is how much new technology and new business models you're absorbing from the market, that the company is actually digesting from outside that was new and is making your LP better, right? And you can measure that in number of pilot projects, you can measure in R&D savings, these sort of things. As a second KPI would be, how much of your portfolio companies are you selling to your customers? When you create a business, I cannot talk numbers, but in SE Ventures, we were wildly successful doing that, where the amount of money that Schneider Electric is selling to their customers, but from a solution that we don't do anything. Sometimes we white label or whatever, we will repackage or whatever, but it's coming from a startup. It's really big, and those sales also often have very good margins. Another one could be if your corporate decided to buy some of your portfolio companies because they liked so much, they feel a gap in your product portfolio, or they can take you to a new market and so on. That is also another great win for your corporate. Another one is when you see you show your executive committee the light of, oh, this is a new area we should go into. That is an adjacency, we have an opportunity, and the whole company mobilizes that into that direction because of the intelligence you brought to the table. That is also a win. That's how I understood the question about how do you know whether you're winning as a CVC, and also, of course, financial returns. You cannot lose money. If you start losing money, if you're in that 50% that returns less than capital, eventually they're going to shut you off. Some CFO is going to come and say, this is a mess, we can do this in a different way, and they're going to shut you off. So you need to make some profit. It doesn't have to be 5x, but you need to make some profit.
Yeah. And I think that leads to another question, which I saw from Matthias Brandau, which is how to manage expectations when the results don't follow as expected. Because so let's say you're not losing money, but it's not going, you're not showing huge returns, and also it comes back to that question of, okay, so you have these strategic KPIs as well, but sometimes they're a little bit woolly. Again, there can be some question marks over whether you're meeting those. So how did you in each of your cases sort of do that expectation management, especially when times were a bit tougher? I don't know who wants to jump in first. Harry, you're smiling.
You look like you wanted to jump right on that, so go for it.
Yeah. So let's go to you first. You look like
Okay, so the first and very, very, very important to anybody in a CVC, at the beginning, you need to manage expectations to your corporate. So the first thing we say in Silicon Valley, an overnight success takes 5 years. That's an overnight success. Normally, a normal success is 10 years, right? So you need to tell them about the J curve to say, look, when we start investing for the next, and I told you, for the first 4 or 5 years, I'm going to give you only bad news, because we invest in 100 companies in year 1, and then by year 3, half of them have died and so on. And then only on year 5, 7, you start getting the good news of the winners, right? So you need to manage expectations about the J curve, the percentage of losses. Big companies are risk averse. They're there to manage risk. As a VC, you're there to seek risk, to seek alpha, to seek that crazy idea that is going to change, your industry. So you have to take those risks, and you have to lose money, and you have to do that. But overall, as a portfolio approach, you need to do well, and that will give you not only the financial returns, but also the technologies that are worthwhile for your parent company to adopt and to take to market and to ride that wave. So you need to manage expectations from the beginning.
You're so right. It's so right.
Did you do that as well, Lisa? I mean, how did you set it out?
Yeah,
I love that.
That was
5 years of bad news.
Yeah, I mean, we had a clear plan, whatever you want to call it, a clear, expectation when the thing was formed at GE, and certainly the same at AHA, Heart Association, that just exactly what Harry said. I mean, that's a huge part of everything. It's also one of the reasons the CVC rule is hard, because everyone's a critic, right? Everybody especially in the C-suite and the board, want to know why you haven't made $1 billion yet when they're watching the market climb and, all the crazy of the last 3 years. Why aren't we part of that? And it's like, if you've just started investing, like, it's just not how the world works. I mean, maybe there's an anomaly now and then, but if you're 5 years in and you haven't started to create returns, somebody's going to say, well, why are we, spending all this cash? We need cash flow. Or you get all the write-offs in the earlier days. That's a real bummer for them to write off, deals. Yeah, Harry's 100% right. That is number one with a bullet.
Yeah.
There's something else. You need to agree from the beginning, or at some point in the journey, on measurable KPIs, right? That cannot be fuzzy. Have you done a lot of pilot projects? Have you saved R&D? Are you selling some of the solutions to your customers? Have you acquired any of these companies? Have you produced some, market studies of deep dives that have opened the mind of other people? You need to put numbers into that, and then you follow those numbers, and you, as a CVC, you deliver on those KPIs. Every CVC is a double bottom line, right? It's like all the strategic returns for your LP. So you define them. Can be 1, 2, 3, 4, whatever, and then the financial returns, and then have objective things. And then the financial returns make very clear that it's only going to start looking good after year 5 or 6. Buy yourself some time, because you need that, right?
Yeah.
And you also need to engage in a lot of prayer that management doesn't change during those 5 or 6 years, because if somebody new walks into the CEO or the CFO role during those 5 or 6 years and sees the J curve down below the bottom of the J, you're a target. I mean, it's really tough, that part.
Yeah. And actually related to that, I had one more question about this internal stakeholder management issue, and then we can turn to some of these questions, because there's a bunch of interesting questions about the sort of external side, which I'd love to come on to. But just one more question about, the sort of the investment committee piece, right? So to set up an investment committee gives you a lot of freedom, but you have to have the right people on there.
Yep.
And so I just wondered if you had thoughts on, who should be on there. And then if you do have to have someone on that committee that maybe isn't as much of a fan or a believer, or doesn't really understand how venture works, how do you speak to them to get them on board? Well,
I think part of it is the design of the committee, and part of it is the communication with the committee, and part of it is the process of the fund. I mean, so, I think the best practices are, from a process standpoint, is you shouldn't bring a company to the investment committee that they've never seen before. There should be 2, at least, presentations about the company. First being, this is something we like a lot, and here's why, and we're going to investigate it. Are you comfortable with us pursuing it further? And get a little buy-in before you go further. bring it to vote a second, on a second visit. I think to the extent you can make the investment committee entirely made up of people from the fund, you're better off. It's rarely possible. But if you can, look for the person in the C-suite, hopefully, that understands the idea of risk and investment, you're much better off than getting somebody whose job it is to manage, cash flow down and worry about this quarter's results. Operating, when you have to have operating people, most funds have somebody either from the direct related operation to the company on the investment committee, or a standing person or two from the operating side. Again, you got to really be careful about keeping them up to date, keeping them up to speed, really understanding their motivations, where they feel competitive with what you're doing, and be a good communicator with them, not just see them in investment committee meetings, but be in touch, like constantly be communicating with them, talking to them, collaborating with them, seeking to be partnering with them in a way that is productive for everybody, because otherwise you're just going to get shot down left and right.
Yeah. And Harry, I think you, I just wondered if you had thoughts, because I think, I remember you saying that, like to try not to have maybe the CFO on there, because they would come at this from a different mindset. I've also heard other people say this as well, but do you think that's fair?
Absolutely. I mean, if you have no choice, you have to do exactly what Lisa said, but that's so painful. It's walking with a stone in your shoe. So we have a saying in Mexico: it's better to ask for forgiveness than to ask for permission, right? So what you want to do is to set up your IC and get as much empowerment as you can to the level, as much higher level of that you can in terms of millions of dollars, that the professionals, you and your team, and the team can be a combination of VCs and company people and so on, but people who understand and are willing to take risk, measure risk, take the decisions, and then inform. That's the, asking for forgiveness, inform the company what we did, why we did it, and so on, and try to partner. If you have inside of the decision making or the investment committee people who do not understand venture, who are traditional corporate people, it's going to be really painful and difficult, and you might not make the right type of decisions. That is a recipe for failure. So you, when it gets to a $50 million check or something bigger, that's when a CFO or corporate people can start understanding, because companies at that stage, they start having revenue, they start having EBITDA, they start having, or a line of sight to that, numbers and things they can understand and do something with. But on the early stages, when you're putting the $10 million, $15 million check on a pre-revenue company that has some cool technology, but they have nothing, they're going to say, what is that? Why do you want to do that? So the best is not to play that losing game, but to try to change the game, that you have really the, how you call it, the freedom. And if you have to choose, don't choose the financial people, choose the CTO, or choose somebody that is more technology driven and things like that, to have as adult supervision inside your, rather than the financial people, which is all about risk mitigation, right?
Yeah. Okay. So
also, I've helped form a few corporate venture funds, and in each case, one of my suggestions is bring in an outsider to the investment committee, somebody not in the fund and not in the company, but who is familiar with the industry and familiar with venture capital. It could be another venture capitalist from a financial VC, somebody who helps moderate the discussion in a way, not moderate officially like you are today, Maya, but moderates the risk taking, the risk management, the future thinking, all of it together, who's not, invested, if you will, and I mean that in the not money sense of the word, in the outcome of the decision, but who has pragmatic knowledge, and pay them, for the privilege of being there, and pay them cash or something, but treat them as an investment committee member, a full voting member, and have them get, ingrained with the team. And I think that's a really valuable thing to do.
Yeah, amazing. Okay, good suggestions. Now we've got a bunch of questions about the sort of the other side of this, which is the relationship with the portfolio companies. And I think this would be really interesting to dive into a bit. So, a lot of questions around, do you think CVCs get the access to the best deals? Can you match the speed of VCs? And also, I think these three questions are all related, but, is there still a difference in perception that startups have about CVCs, or have we moved beyond that?
I think that's over. I think it's over a long time ago, actually. I mean, when I started in venture, which is, back in the late 90s, CVCs were very second-class citizens. And after it slowly changed, but after the 2008 crash, CVCs were the only ones investing money, frankly. And they suddenly became, very valuable, and they should have been valuable all along. Part of the change, though, was CVC started hiring more professional people into the jobs. So I think that's part of it. But I don't think there's a difference anymore. I think, companies want smart, good, helpful people on their boards and in their cap table. And if you're smart and helpful and good, and especially if your company can add some value in terms of revenue or strategic, fit of some way, they're equal. I don't think there's a difference anymore. The amount of money that comes from CVCs versus financial VCs, it's rapidly approaching equal. So,
And the speed part, are they, can you do deals as quickly as a VC, because you've got these?
Depends on how you've structured the investment committee and the process.
Yeah. Well, what about you, Harry? Did you find that it was easy at SE Ventures to get in all the deals you wanted? Or, I mean, obviously nobody gets into all the deals, but.
I would agree with everything Lisa said. Just two small, let's say, perhaps exceptions. We had, and I think that still happens, especially on early stages, companies that we wanted to invest in, and they didn't want to take our money because they didn't want to have the Schneider name inside, because they wanted to sell to GE and ABB and Siemens and everybody else. So they wanted to be the Switzerland, and so that still happens. I think happens more at early stages when the company is already bigger. They have less qualms about bringing other people. Once they have all the people as customers, they don't care as much. But that has happened to us, and it was not because we were not good or they're on time. Just they didn't want to have the brand name.
What can you do about that, though? I mean, do you try to persuade them, or are those cases where you just have to say, well, look, sorry, okay, we'll come back.
We try to tell them we're independent. There's some firewall. We have carry. We want to make you successful. I want to sell my stake in your company the highest possible because I have the carry. I'm on board with you. We try to explain all that, but some people are not persuaded because they have other options. Of the good companies have their peak of who they take money from, or they used to. That's so 2021, right? I don't know how it is now, but that happened, and so we lost some deals because they didn't want the SE Ventures name because they know it's associated with Schneider Electric. But on the other hand, we won other deals at higher valuations of companies who are rocket ships that we were competing against one slot against 7 people, including really well-known financial VCs. But we were able to mobilize the sales force of our corporate and come and say, we are going to help you sell. Here's the plan. Here's the people who are going to help you sell. We're going to bring revenue to you, and meaningful revenue, millions and millions of dollars. And the startup said, I buy this thing. You're the best investor to have around the table because you're going to help me build the company. So we won that deal. So it cuts both ways.
Yeah. Okay. And I think a kind of adjacent question to that was also, are you finding that now startups are actually expecting more from a CVC investor, and that there is a sort of expectation that there will be some business? I mean, because you're describing a situation where you're telling them all the things that you can do, but I wonder whether startups are now coming to you already with this kind of, yes, we'd love to do a deal, and this is what we would want. We would want a POC. We'd want.
Yeah, I think you have to, different companies have different strategies for this. So some CVCs are not allowed to invest in companies unless there is a corporate deal in the works or completed, and some CVCs say, don't even think about it. If it makes sense, it makes sense, and we'll get to it when we get to it. I think you have to be very clear with the portfolio companies, very honest with them about what you can deliver. Obviously it's clear if they already have an operating agreement with the company that it's going to work, or if there's a clear obligation for that. But if you're going to wait around on an operating agreement, you may miss the investing window, because those operating agreements in very large corporations can take, from now till the end of time to complete. And so, I don't know. I used to tell people at GE, we are not investing in companies around the core. The odds that you're going to get a business deal in the short term are low. I'll do my best to help you. But, you should know that this is more about helping you like a traditional VC than it is about guaranteeing you, an operating check from GE. And I think that strategy is generally more effective, because if you're only investing in companies that can get a partnership agreement before you put in the money, you got a long wait. That's painful.
But were some startups disappointed that they weren't getting?
Yeah, I'm sure they were, but because not everybody believes you when you tell them the truth. But what are you going to do?
Yeah,
you still got to add a value to them. You still got to make connections to them. I used to make connections to people at portfolio companies, to our competitors all the time.
Yeah,
because what was my role was to make sure those companies were successful, not to make sure that the deal with GE happened, because that's how we set up our fund.
Yeah,
again, it was part of the KPIs from the very beginning. Wasn't how many strategic deals do you get done with GE? It was, very returns oriented, and also sort of innovation fluffy thing oriented, but not about checking boxes about how many corporate deals got done.
Yeah. But yeah, as you say, it's very different for those, when that's a prerequisite that there is a deal. Then I guess the answer to that, though, is just being completely transparent with we work this way, and I wonder whether that's something that needs a little bit more light shed on it, for the sake of startups, is for them to understand how certain corporations invest, and how that some will fall into this category and some will fall into ones where they're really not looking to connect you up with a business unit.
Look, if you're a startup and you haven't done some research on who your investors are going to be, like you haven't checked in to talk to some of the companies that the fund has invested in before, you're kind of crazy. I mean, you should really know, you should do your due diligence as a portfolio company too, and talk to some of the CEOs of other companies that are taking money and see how it goes. Like, was it a valuable investor? This is true of whether it's CVC or regular VC, by the way, is they should do diligence on what the investor's experience is like, or this company's experience is like with the investor, and be confident that they're picking somebody good for them in whatever form that takes. And so just taking the money and hoping for it to be a good relationship. It doesn't, it's a marriage, and divorce is ugly.
For sure. Now, there was an interesting question earlier, which I think, Harry, you sort of answered in the Q&A as well, but it'd be interesting to go into, because this is an audience that's heavily CVC investors. And there was one, what advice or what would you say to a CVC investor who does want to make the transition that both of you made, which is then to go into traditional VC? I don't know, Harry, it's very fresh for you. So any...
VC cares only about money making. Very simple. So if you're in a CVC and you want to move to VC, focus on deals where you think you're going to make a lot of money. Deals that will have, those 3x or that great IRR. Focus on making those deals. Second, make sure you get attribution to those deals, that you're the person who sourced it or who did the deal or who sits on the board. That is your deal, or you are part of that deal team, right? And then make those a success. And right now, it's not a very good time to jump from CVC into VC, because there's going to be downsizing in VC. It's very difficult to fundraise because of the denominator effect. And I have intelligence in the market that even VC firms are going to be laying off people. So it's not a great time. So hunker down, do good deals, and in 24 months, based on your track record and your domain expertise of experience, you can make inroads into getting to VC.
Yeah. Okay. So hold fire. And I guess, we don't know yet how long this downturn is going to take. So we'll see. Okay. Well, I think, on that note, I know we didn't get to all the questions, but what we can do... Can
I say something that I want to say from a different question about the speed? Mm-hmm. That is correlated to how your setup is in your investment committee. But if you have that independent investment committee, you have the ability, you have the empowerment, and you should have the ability to process deals really quickly, because the best deals are not going to wait for you. They're not going to wait for an approval from corporate. They're not going to wait for a commercial contract. You just have, if you believe that this is strategic and a good investment, you should be able to move fast. So you want to have that freedom.
Mhm.
Yeah, and I think my last comment would be, look, when you take a job, the most important thing is that you enjoy your job, you enjoy your colleagues, you feel good when you go home at night, and when you get up in the morning, you feel that it's rewarding to you in the way you define it. Neither company, neither type of venture fund is stable and secure. They both have their risks, and they both have their dramas, and they both have their greatness, and so it's more of, I think, about choosing the job that suits you, makes you feel good about yourself and your colleagues and all the rest, than it is about one is better than the other. I've gone back and forth, and I would continue to go back and forth if that were if the right place, the right time kind of situation. I had great experiences in both, sides of the venture market. And I, hope to continue to do so someday after I get past my, I need to be an operating person itch again.
Yeah.
But, it's not a black and white experience.
But it does sound, based on what you've said, that you would look fairly carefully at the structure of something.
Hell yeah. But of either one. I mean, I would never go to a financial venture fund where I wasn't on the investment committee again. Where I wasn't a partner again. I just wouldn't. And you have to have some, determination over your own destiny in either situation, because that's what's important to me, and I think if you're younger in your career, it may be different. There's all sorts of considerations, and you just have to, liking your job is more important than optimizing for perfection. Whatever that means.
Okay. Well, I think we're probably going to have to leave it there, because we're almost at the top of the hour, and I have to do a kind of few housekeeping notices as we finish off. But thank you so much, Lisa and Harry, for sharing that. I think what I would say to the audience is, there's a lot of questions today, and what we can do is we are going to keep writing about this in Global Corporate Venturing. So come back and check out our website, because I think some of these issues around remuneration, or the difference between, investing from a dedicated fund versus off the balance sheet, and the pros and cons, or how, I think it's pretty clear from your point of view, maybe it's definitely the dedicated fund is preferable if you are stuck with having to invest off the balance sheet. Are there ways, of making that work? I mean, these are all questions that we intend to look at all the time. So I would say, come back. We're going to do a write-up of some of the main lessons that we can draw from this discussion. So a lot really for people to if you're interested in this topic, just please do come back and check it out. But so Lisa and Harry, thank you very much for that. And I've just got a couple of, concluding things to say. So if you enjoyed this discussion, we do have our next wave webinar is coming up on December 14th. This is one where we're looking at space tech, and I'll give you the updated sort of panelist list of that fairly soon. It's not quite finalized yet, but we have some very good people who can talk about what's coming up there. And the webinar series will continue into the new year. Then if you enjoyed this, but you'd actually like to meet people in person, come to one of our events. So the two big ones that we do are the GCVI Summit, which is in Monterey in March. And then if you're more European based and you don't want to travel that far, think about the GCV Symposium, which is in London. Both of them are excellent. People describe them sometimes as therapy sessions, because you get to have this kind of discussion and the sidelines. We've got an excellent program, but I think what people really enjoy is having these frank discussions like we've just had now about how you sort of navigate some of the headaches of your job. So I would recommend both. And you can get a discount if you sign up for one of those and you put in Next Wave, because we love our webinar audience and we want to give you something back. And then the other final thing is, if you have time and you work in CVC, we really are on a mission to kind of do some benchmarking and understanding of what normal and good looks like in this industry. So we do this annual survey. It does take a little while. There's quite a lot of questions, but I feel that it's super important for this community to kind of really share what best practices, and we can only really do that if people participate. So if you would take some time, anybody who's participated today will be getting an email from me with some links, and if you could just take a moment to do that, We'd really appreciate it. And also we have these annual awards for people who are rising stars and emerging leaders in this profession. Also part of this whole idea of really understanding what good looks like, professionalizing. If you have somebody on your team, or if you think you're a rising star or emerging leader, then it's really easy to send through a nomination, and then you get put into our list, and it's a great accolade. And I've done a little bit of follow-up, and people who end up on the Rising Stars list, they generally get promoted. So it's, you know, it's a good thing to do. And actually, as a little incentive, if you do fill in our annual survey, so this is the long one, you can be put into a prize draw to win a pass to one of our events or some professional development courses. So a little extra incentive there. And finally, just to say, if you enjoyed this and you want to get in touch, you know, please do email me, or, you know, if you just want to kind of come and read more stuff, globalventuring.com is the place to come. And we're always happy to hear about you. So hopefully we'll see many of you at the next webinar series, and I am 2 minutes over time, so I think I am going to have to end there. Very big thank you again to Lisa and Harry, and thank you for all the great questions. It really made this a lively discussion, so I enjoyed it and I learned a lot.
Bye, everyone.
Bye.